Welcome to This Explainer. Today we're going to break down the absolute paradox of SpaceX's recent, highly volatile transition to a publicly traded company. We're looking at a completely fascinating situation here, where one of the most innovative businesses in human history collided head-on with the brutal, everyday realities of the public stock market. 53.5%. Just let that sink in for a second. That is the massive percentage of value, representing over $1.2 trillion, that was just erased from SpaceX's peak in a matter of weeks. It's a staggering drop, and it poses the ultimate question for us today. Can a truly great, world-changing company actually be a bad investment if you buy it at the exact wrong price? All right, let's get into our first section, the post-IPO roller coaster. So let's dive right into this wild ride. The whole story kicks off on June 11th when Goldman Sachs led the highly anticipated IPO. They priced the shares right at $135. And look, given SpaceX's massive dominance in space and their huge ambitions, the hype was absolutely off the charts. And, well, because of that hype, investors just went completely crazy. Within days, they rocketed the price up to an enormous post-IPO peak of $225.64. I mean, everyone thought the sky, or actually scratch that, Mars was the limit. But reality hit incredibly hard. As that initial euphoria wore off and investors started actually looking at upcoming share unlocks and capital expenses, the stock crashed all the way down to $104.83. It literally erased more than half its value from the peak, falling well below its initial IPO offering price. Ouch. And then, after all that chaos and panic, it just bounced right back to close around $140 by mid-August, leaving the entire market completely dizzy. If you just looked at the last few weeks, you might think the stock crashed, bounced, and is now cheap. But as you'll see, that is exactly where the analysis becomes dangerous. Now, what's really unusual here is this massive 30% flow allocation to retail investors. That is roughly 3 times the normal amount you'd usually see in a mega-cap IPO. SpaceX essentially opened the floodgates for everyday investors. But the high entry valuation, combined with this enormous retail presence, really set the stage for what some financial analysts bluntly called a retail bag holder slaughter when the price ultimately collapsed. Moving on to the next piece of the puzzle, the engine, Starlink, and AI. Underneath all that stock volatility, there is a very real, very powerful engine at work. First up is Starlink. And listen, we aren't just talking about a cool little experiment anymore. They are operating around 10,000 low Earth orbit satellites and generating a massive $4.29 billion in connectivity revenue in the second quarter alone. That's recurring, predictable cash flow, which completely changes the economics of the company from just selling rocket launches to operating a dominant global communications network. But actually, SpaceX is evolving way beyond just rockets and satellites. They're morphing into a genuine AI infrastructure giant. By integrating their XAI acquisition right into the core business, they've pulled in $2.56 billion in AI revenue, which is up an astonishing 247% year over year. They are building a vertically integrated AI platform that combines compute on Earth, connectivity in space, and energy infrastructure. This massive computing pivot is exactly what drove Morgan Stanley to issue a spectacular $300 base price target. Which brings us to our next point, the multi-billion-dollar capex. Now here is where the bull and bear cases collide head-on. Because as it turns out, building the future of humanity and constructing the backbone of global artificial intelligence is terrifyingly expensive. SpaceX generated a massive $7.8 billion in total revenue in the quarter. That is phenomenal top-line growth. But to construct that future, they burned through $18.3 billion in capital expenditure, with a staggering $15.8 billion spent just on AI infrastructure. They are generating cash, sure, but they are spending it twice as fast to build out their massive capacity. When you actually factor in all that massive spending, you're looking at a $541 million Q2 net loss. Add to that the heavy shareholder dilution from their $60 billion all-stock Cursor acquisition and operational setbacks like booster issues on Starship's 13th flight, and, well, the risks really start to pile up. It shows exactly why Morningstar issued a stark cautionary warning before the IPO, stating the company was significantly overvalued and, realistically, only worth about $63 a share. So, how does the stock hold up? Let's look at surviving the supply shocks. The true test of investor confidence really comes down to how the market absorbs massive waves of shares. If we track the timeline of liquidity events here, we see that June 11th IPO led right into a massive 911.5 million share unlock on August 6th. A lockup expiration just means early investors and employees are finally allowed to sell their shares on the open market. And that early August event set up incredible suspense for another 320 million shares slated to unlock just 2 weeks later on August 20th. Now, many traders fully expected a massive crash on August 6th, given that flood of new supply. But with roughly 16 to 34% of the tradable float shorted by pessimistic traders betting against the stock, we didn't get a crash. Instead, we got a classic short squeeze. When the stock didn't immediately plummet, those short sellers basically panicked and were forced to buy shares to cover their positions, pushing the stock up over 6%. So the market absorbed the initial supply shock, but it was driven largely by market mechanics, not necessarily purely by long-term buyers. But, the danger isn't over. Because on August 20th, another 320 million shares become eligible for trading. At current prices, that represents nearly $44.8 billion worth of stock. It's a massive liquidity test. The question isn't really whether all those shares will be sold, because they won't be. The real question is how the market reacts to the mere potential of that supply. And keep in mind, early investors are sitting on absolute life-changing gains. Take Alphabet, for example. Their 2015 investment of $900 million, that has ballooned to a roughly $94.2 billion. That is an absolutely insane return. At some point, early backers with those kinds of astronomical gains might just want to take profits, completely regardless of how well the company is actually executing today. It's really a matter of wealth concentration, not just belief in the company. Which brings us to our final section, the ultimate valuation question. Stripping away all the hype of the rockets and the allure of AI brings us to the absolutely most critical investing lesson you can take away from this explainer today. As the analysts in our sources pointed out over and over again, an extraordinary company with the best rockets, a dominant global satellite network, and incredible AI ambitions does not automatically make for a cheap stock. If you price in a decade of flawless execution today, any slight delay or capital strain can send the stock tumbling, even while the company itself continues to change the world. So as we watch that August 20th unlock and as we weigh the massive multi-billion-dollar cash burn against their undeniably incredible future growth, you really have to ask yourself, what price are you willing to pay today for the SpaceX of tomorrow? Is it a $300 AI powerhouse or a $63 cash-burning machine? The market is battling every single day to find out. Thanks so much for joining me on this explainer, and we'll catch you next time.